and welcome to our guest, Howard Marks, co-chairman of Oaktree Capital. Howard, great to see you.
Nice to see you, Andy.
So first of all, can you tell us a little bit about Oaktree for people who aren't familiar with the firm?
Well, Oaktree is a global alternative investment manager, which basically means not mainstream stocks and bonds, with its roots in credit. We're approaching 30 years old, and we're around $200 billion under management.
And Brookfield is now the owner of the company. You guys have a big stake in it, the original partners, right?
Well, they may say the owner. We may say they're our partner.
Okay.
Brookfield has bought out the public and bought part of our stake, and they now own 68%. And employees, ex-employees, and founders own the remaining 32%.
Jumping right into some of the topics you like to talk about, which includes risk. And I know you did a video recently about the misconceptions that people have about risk. What are they, and can you explain what you meant by that?
Well, the main misconception, Andy, is that people want to be able to take the word risk or the concept of risk and use it in a formula to do computations to figure out what are the best possible alternatives and how did people do well in the past in a risk-adjusted sense. So the only number that's available for them to use as a proxy for risk is volatility or the standard deviation of prices or returns. So they do. I think that that's not what risk is. Risk is really, if you think about it, it's the possibility of having an undesirable result. Simply translated, or I should say most simply translated, the probability of losing money. So that's risk. The other thing is not risk. On the other hand, there is no number you can use for that because there's no place you can look to find out what the probability of a bad outcome is today or what it was 6 months ago when you made the investment. So you can be quantitative but not accurate, or accurate but not quantitative. You can't do both.
Shifting gears a little bit, what is your thinking about the high net worth market, both in terms of selling to it and in terms of investors looking for things to buy?
I think that, America is distinguished around the world by the magnitude of the high net worth market, by the number of people who have large amounts of net worth, and the fact that more people are joining that group all the time. So it's a great market, and alternative investment firms like mine have the opportunity of selling into that market. The people are historically underrepresented. The institutions did it first, in other words. Things like private equity, distressed debt, private credit, real estate, anything along these lines. So it's a great opportunity. I think that to really do our job right, we have to pair it with education. Educating the consumer is not that easy at any level. And the singular goal should not be to sell products to that market. It should be to educate that market and then sell it the things that are right for it. I'm very interested in education and spend a lot of time on that myself.
But sort of increasing allocations for high net worth individuals could be appropriate given that they have a good understanding of what they're getting into.
Right, as long as you use the word could.
Right.
Could be appropriate. It's not. There's nothing that's right for everybody. People have to understand how to make decisions about how much return to pursue, how much risk is involved, and what's the right risk and return target for them.
Right. You recently wrote a piece where you talked about the difference between ownership and debt and said that was really critical to understanding investing. What do you mean by that, and why do you say that?
Well, people talk about the many ways there are to invest: stocks, bonds, real estate, private equity. I've named a
derivatives
bunch of them.
You mentioned
yes,
as well, right?
Derivatives, currencies, commodities. But really, if you want to think in an organized fashion, I think you should think about ownership and lending. If you want to invest in a business, let's say your brother-in-law says, I'm going to open a restaurant, and I'd like some support. You have two choices. You can say, okay, I'd like to be a partner, I'll take half. I'll put up half the money, I get half the profits. I don't know how you'll do, but I'm going to back you. Or you can say, I'm not that confident it'll be great. I'll lend you some money, but I want you to promise me that you'll pay me interest every 6 months and give me my money back at the end of the term. And I get paid before you get paid. So my relationship with you is contractual and senior. So that's the difference between stocks and bonds. A stock is a partial ownership of a business with no promise of anything other than your share of what all the owners get, if there is something. A bond is a promise of interest and repayment of principal in a priority basis. If you think about it, the two have nothing in common. They're not, oh yes, well, stocks and bonds, they're a little different. They're both securities and here's the difference. No, there's nothing in common. And for the most part, ownership assets give portfolios their dynamism and their upside potential, but at the cost of being uncertain and having significant downside potential. Lending assets have a fixed promise which is dependable but limited in its upside.
I remember once hearing you say, Howard, there's no bad assets, only bad prices. What do you mean by that?
Well, look, I started work in this business 55 years ago last month, and at a bank, and the banks invested in what were called the Nifty 50, the stocks of the 50 best and fastest growing companies in America. Companies that were so great there was no price too high. Nothing could ever go wrong. And if you bought the stocks the day I got there and held them tenaciously for 5 years, you lost over 90% of your money. Why? Because they were too expensive. It's not what you buy, it's what you pay that determines a good investment. Now, the longer your time horizon, the quality of the thing you buy matters more and the price you paid matters a little less. But still, people have to understand that good asset is not synonymous with good investment. To make a good investment, you have to be price conscious. And so, you know, that's really what it comes down to. It's not a matter of buying good things, but buying things well. And you have to understand that difference, and it's more than grammatical.
All right, that leads me to ask you what you think of the equity markets right now. I know you're not necessarily a big equity person, but are we in a new Nifty 50 era with, say, the Mag 7? What is your thinking about equities?
The easy answer is to say we are, not necessarily correct. You can't make any meaningful observation about assets unless you know them extremely well, and I don't. First of all, Oaktree generally doesn't operate in the stock market, being alternative managers. And secondly, I am not tech savvy, growth savvy. You know, it's just not my thing. So I don't want to mislead anybody. These are prices which on the numbers look expensive. We gauge that by looking at the price-earnings ratio. They have high price-earnings ratios. But, sometimes a high-priced car is worth it and a low-priced car isn't worth it. So low prices and cheapness are not synonymous. I think everybody thinks these are great companies. They may be great companies. They have high PE ratios. They may be deserved. So I don't think people should have a knee-jerk reaction on that subject, and I try not to.
Getting back to the paper you wrote recently, you talked about a sea change in interest rates, and you mentioned the 2009 to 2021 era.
Yeah.
Can you explain that a little bit more?
Well, I start the memo, Sea Change, December of 22, available to all your viewers gratis on the Oaktree website. And I say that in 1980, I had a bank loan outstanding on a personal basis, and I got a slip in the mail saying the rate is now 22 1/4. 40 years later, in 2020, I was able to borrow at 2 1/4. So interest rates went down for me by 2,000 basis points, 20 percentage points. Anybody who came into this business after 1980, that's 44 years ago, so it's almost everybody in the business, has only pretty much lived through declining interest rates or ultra-low interest rates. And interest rates hit their all-time low in the period you're talking about, 09 to 21, which is the subject of the memo. I think the Fed funds rate, which is the overnight rate that the Fed charges banks, got down to zero at the beginning of 2009 because they had to fight the global financial crisis, stayed low pretty much until the end of 21 when they decided to raise it to fight inflation. And in that period, the Fed funds rate was zero most of the time, and I think averaged about 0.5%. Now, people tend to say, well, this is what I lived through, this is normal, I'm going to extrapolate it to the future. And the whole point of the Sea Change memo is that they should not extrapolate that experience because that was an unusual time. We were fighting crises, both the global financial crisis and then the pandemic. And you should not make financial decisions based, in my opinion, on the assumption that the future is going to look like that. So declining interest rates and ultra-low interest rates dominated the history of the last 44 years. But I don't think they're going to be the norm going forward, and that is a sea change.
Why do you think we're going to be in a higher rate environment, though, Howard?
I think we're going to be in a normal rate environment, and that period wasn't normal. That period, as I said, fighting the global financial crisis and fighting the pandemic through monetary policy was very important. It was well called for and well delivered. And it worked. We're still here. You know, after the Lehman bankruptcy in 2008, people were talking about the meltdown of the financial system. Didn't happen, thanks in large part to the Treasury and the Fed. But the emergency is over. The emergency rates of zero are no longer called for, in my opinion. And when rates are extreme, they skew the financial markets. When rates are too low, they subsidize asset owners and borrowers, and they penalize savers and people living on fixed income and lenders. And I think the authorities, the Fed, the Treasury, should not be in the business of doing that. They should let interest rates occur naturally through negotiation between borrower and lender. And I don't think when the lender and the borrower sit down to negotiate, they're going to agree on 0.5% or zero.
You also wrote in the memo, Howard, I've been urging increased investment in credit. Why is that? And in particular, when others like Paul Tudor Jones and Stan Druckenmiller are saying bonds are a bad investment or even short treasuries, et cetera.
The things that I say are not talking about what's going to happen in the next week, month, or year. I'm not a trader. My investments are for the long term. I think that's the difference between trading and investing. I'm not predicting that bonds are going to go up in price. I'm not saying it's a favorable trade. What I do think is that there are lending investments today, bonds, loans, etc., from which you can get a substantial contractual return. And that in itself can be attractive. And you can do it on a dependable basis. For example, take high yield bonds, which is an asset class that I've been in for the last 46 years, ever since I started that activity for Citibank. Today they offer about 7% interest. Well, that's a good level. And if you're somebody who's got some money, you want to invest it, you want to make a good return, you don't care about hitting a home run, let's say you're close to retirement, you'd rather have a substantial income on a steady basis than have a lot of moonshot potential. You might say, I like 7%, I'll take it. And of course, for the individual, you have to pay taxes, everybody has to pay some management fees, etc. You can have some credit losses. But I think that if you invest in a portfolio of high yield bonds at 7, over the long term, you're likely to get 6, at least. A lot of people should, in my opinion, say, sounds good to me, I'll take it. Somebody who's smarter, who says, you know, I think the next move of interest rates is up, which means the next move of bond prices is down, may not want to do it at that time. It may not be attractive for a trade, but it may be a good long-term investment. And my goal is not to predict the movement of prices, it's to make loans to companies that will pay me back.
Right. I love that point that you made, that people should understand the risk-return relationship and then consider whether or not there's an alpha manager, or a manager that delivers alpha out there. But alpha managers are not often sustainable, are they?
Yeah, well, I think that's right. Or Don Meredith once said on Monday Night Football, they don't make them the way they used to, but then again, they never did. You know, by alpha, we mean managers who have above average skill sufficient to produce above average returns without above average risk. I think that's my definition. And clearly not everybody can be above average. Not everybody who claims to be above average is probably above average. Some people who look to be above average for a short period of time, it may turn out to have been luck or that they ran into an environment that was perfect for them. But there are probably some managers out there who are dependable and above average. We try very hard to be one. Hopefully they can get you an increase in return, which is not accompanied by a proportional increase in risk. And obviously, a person like that, a firm like that, can be very helpful to the investor.
Yeah, that's one of the great debates of the investing world. I want to ask you about the business, private equity, private credit in particular a little bit. You were one of the pioneers there, but a lot of people have been rushing into this business. Are you concerned there's too much capital there, maybe even a bubble?
Well, I don't think it's a bubble. A bubble is a certain word which has come into broad use, I would say, in the last 20 years. I mean, it's always been around, but it's been popular, especially in the media, in the last 20 years. And a bubble to me means a psychological state of mind where people have lost their mind and they're excessively euphoric, making silly investments and riding for a fall. I don't think that's what we're talking about here. Most things are elevated today. You asked about the stock market before. The stock market is clearly on the expensive side. We look at the PE ratio, the price-earnings ratio of the S&P. It averaged 16 for the post-war period. Today it's 22, 23. It's a little above average. It's not crazy. In 2000 it was 32. That was crazy. 22 or 23 is not crazy, but it is certainly not cheap. Even when you take out the Magnificent Seven, which are substantial in the index and pull the average up, you're still not. You're still probably in the high teens. Expensive, but not nutty. Most things are expensive today. Why? Because most investors are optimistic. We've gone through a good period. We've beaten the challenge of inflation, apparently without producing a recession, what they call a soft landing. Normally, you fight inflation with tight policies which produce a recession, not necessarily in this case. So things are going well. People are optimistic. They have bid prices up to most things. People are unworried. That usually equates to high prices. So there aren't too many great bargains around. I wouldn't argue that almost any market is kind of, desperate on the bargain counter. But still, there are smart things to do today, but this is not the climate, in my opinion, in which to push out on the risk curve, because we talked before about the importance of buying things well. It's harder today to buy things well if things are a little elevated in price.
I want to ask you, Howard, a little bit about you. Have you ever considered, looking back in your life, why you decided to become an investment manager? Growing up, for instance.
Well, no, growing up there was nothing. It was not preordained. But in high school, when my buddies said, hey, they're teaching a course in accounting, we should take that. And we took it. I fell in love with accounting. I figured I'd be an accountant. My dad was an accountant. I pushed to go to Wharton. My guidance counselor said I wouldn't get in. I got in anyway. I switched to finance because I found that more interesting, and so forth. And then, I got a summer job at Citi in '68 in the investment research department. Their choice. They assigned me there. It wasn't my idea. I liked it. I stayed. And 56 years later, I'm still there.
And final question, Howard. You have been sharing a lot of your ideas over your career. Why do you do that? Are you afraid, though, of giving away the secret sauce of your success? Talk to us about that a little bit.
Well, first of all, for me, writing the memos which share these things, which I would not elevate to the level of secrets, it's a creative outlet for me. I enjoy doing it. I like to educate. The clients like to get them. And today, the broader audience likes to get them. I'm happy with that. I can tell people about the importance of the things we're discussing, that will not necessarily able them to do the things. So I don't think the oak tree is giving away all of its competitive advantage. And I think that our clients are better clients when we have a relationship which has been built on education and a clear understanding. So I'm happy to do it, and I'm not worried that I'm going to put Oaktree out of business.
Howard Marks, thank you so much for your time.
It's a pleasure, Andy. Thank you for your good questions.